Hi, everybody. This is Jeff Fowler with the Apartment Owners Association. Today we're going to talk about how you can boost your 1031 tax savings, and we'll have some quick calculations and key strategies to help you with that. And brought to you by some of our 1031 exchange GST experts. And before we get into that, AOA, excuse me, AOA's been around for over 40 years. And we are here to bring ideas that will help you make and or keep more money than ever before. We have the magazine, and I don't know if anyone has seen this one. This just came out. So if you're a member, you should have got it. You will be getting it right about now. And anyway, you see a picture there of a billboard. And that's to help people vote no, help and get the word out just about how destructive Prop 33 would be. If you follow the QR code on that, it leads to 7 good reasons to vote no. And there's a couple other good reasons that are more for landlords that we didn't even include on that. It's more for the general population. And anyway, thank you. Many of you have given to make that possible and to do the lawn signs. And right now we're really looking to do more of the billboards. And so if any donations would be greatly appreciated, and hopefully we can put some of those up. And and we even have this little newsletter. It has a page that's for property owners, people who own their own home, and it's not geared for rental property owners. So we have that's going to be in the October issue, and you'll find that. Anyway, if you need more lawn signs, please give us a call or email membership@aoausa.com. We'll get you those lawn signs for free because other members have been pulling the weight and giving. And if you haven't given yet, there's always not always, there's really a limited opportunity, and we're getting close to the deadline. So we'd love to have you help with that. And so, you get the magazine, and just with tenant screening, things have changed a lot. And we have updated products that help deal with the changes that we've had with the criminal records in the state of California. And also we have live streams. And so next week, let me see here. Next week, actually today, we have a live stream with a on-site property manager expert at 12 o'clock. And then next week in San Diego, we have Franco Simone speaking along with that on-site property manager law expert. So that'll be a double header down there. And then the following week in Buena Park, in Hawthorne, and Sherman Oaks, we're going to have double headers, and it'll either be Dennis Block or Michael Brennan, along with someone who has been setting up LLCs and helping people with their tax strategies for 40 years, really an expert in his field. He came highly recommended. So you'll have that as a double header in those areas. And so there is a whole lot that's going on. Go to the aoausa.com website, and all that information will be there. And anyway, we're going to get into our presentation today. And our speaker, really it's sponsored by Real Estate Transition Solutions. So shout out to them and a thank you. They are DST experts. They have 4 offices on the West Coast, including one in Orange County and San Francisco. They do $220 million yearly in replacement property. And you will want to check them out. If you are shopping around, definitely give them a call. And our speaker today is a partner and chief exchange strategist at Real Estate Transition Solutions. He's a CPA with extensive expertise in the 1031 exchange strategies and tax deferral strategies. He leads Real Estate Transition Solutions team of skilled advisors and analysts, serving as both an advisor and advocate for owners of highly appreciated real estate, and that would be you. And he also regularly contributes educational articles to highly acclaimed publications like Business Insider, and among others, demonstrating his profound knowledge in the field. So please join me in welcoming Austin Bowlin.
All right, Jeff, appreciate the introduction and thank you, AOA, for all the good work that you do as it relates especially to not only owner education, but advocacy in terms of trying to restrain some of the elected officials that seem to continuously propose regulation that's not only misguided, but would adversely impact housing across the entire state of California. As Jeff mentioned, my name is Austin Bowlin. I'm a partner here at Real Estate Transition Solutions. I'm CPA as well. I work directly with property owners as an exchange advisor. And today we are going to be discussing how one goes about calculating a tax liability upon the sale of investment property, as well as some exchange strategies available in order to defer that tax liability and ultimately reinvest proceeds into replacement property that is going to be much more reflective of one's financial and lifestyle objectives. We'll be touching on, in brief, a form of replacement property that Jeff made mention to, which is the Delaware Statutory Trust. DSTs are eligible for 1031 exchange purposes as like-kind property, but are also treated as securities by the Securities and Exchange Commission. They are specifically regarded as Regulation D securities, which means in order to invest in a Delaware Statutory Trust or multiple Delaware Statutory Trust properties, one must be what's considered an accredited investor. Typically, accreditation is achieved by virtue of having a net worth in excess of $1 million, not including the value of your primary residence. But alternatively, you can be accredited by having annual income in excess of $200,000 as an individual, $300,000 if you are married filing jointly, or by holding a number of professional licenses or certifications. Here you see an agenda of what we're going to be discussing today. We'll start with a little bit of foundational knowledge, if you will, as it relates to 1031 exchanges. Want to make sure no one's going blind into this conversation and this being the first time they've ever heard about just what a 1031 exchange is. We'll walk through that tax liability calculation, the components of the tax liability. Often property owners will have somewhat of an oversimplified view of how one calculates that tax liability. So intent here is to clear up any misconceptions and then also walk you through our tax liability calculator that we make available for anyone to utilize on our website so that you can actually plug the specific inputs from your own situation, your own property into it, and have an approximate tax liability that would be due if you were to sell a property and not utilize a deferral strategy such as the 1031 exchange. We'll walk through a quick case study to take some of the conceptual, make it more applicable to a real life scenario, share some additional educational resources, and of course, make sure to save time for Q&A as well. As Jeff mentioned, our firm, Real Estate Transition Solutions, we're a real estate advisory firm that really focuses on serving property owners who are in, we'll call it the third and fourth quarter of property ownership. And what I mean by that is typically owners who are in more traditional retirement years. They own real estate that if they were just to outright sell it would face significant tax consequences. None feel those tax consequences more than California property owners, given the state income tax that all are subject to in California. But importantly, with our client profile, they're often looking at the investment real estate that they own today, and they're asking themselves the question of, does this property fit with my financial and lifestyle objectives for the chapters ahead? That's where we come in to walk alongside a property owner and help them answer that question. And if the answer is no, then in turn, what sort of replacement property strategies, tax deferral strategies, liquidity strategies can be utilized in order to reposition the property or the rather dollars invested in that property into something that will serve them over the coming 10, 20, 30, 40 years. By virtue of the work that we do, we perform a significant number of 1031 exchanges with our clients. So on average, we complete somewhere between 150 to 200 exchanges a year. The passive ownership options, the passive replacement property options, such as the Delaware Statutory Trust, are very much an area of specialty of ours. In total, our clients have just over, at today's numbers, around $1.2 billion of DST real estate under advisement from our standpoint and ownership by our clients. We have been in this space for 20 years at this point. One of the most established, longest standing exchange advisory firms in the country working with Delaware Statutory Trust property. Have invested in over 1,400 individual, made over 1,400 individual investments in DST properties. And in total, that's around 235 individual DSTs that have been invested in. So a lot of breadth of experience. We have an in-house due diligence team, 5-person team that puts each and every DST sponsor and every single property through a very rigorous process that is necessary from our standpoint to determine, one, do we feel like this is a quality replacement property option? Do we feel like the returns that are being projected are achievable? Or do we believe in the market, the tenant, the physical structure itself, and allows us to know the properties at the detail and intimate level necessary, such that when our team of exchange advisors are communicating with owners and learning their profile, their objectives, we're able to actually marry those two together and provide the most suitable recommendations for them. Jeff mentioned that we are headquartered up in Seattle, Washington, Kirkland specifically, if you're familiar with the area, and have offices throughout the West Coast, Portland, San Francisco, and Orange County as well. So as I mentioned, I want to establish a little bit of baseline knowledge as it relates to the 1031 exchange. And 1031 exchanges are, frankly, one of the transactions that is the most powerful transaction allowed in the federal tax code. And the reason is because it's the only transaction that allows someone to sell an asset. And in this case, we're talking specifically about investment real estate, sell investment real estate. And instead of paying the tax that would otherwise be due upon that sale, 1031 exchange allows an individual to reinvest those proceeds into replacement property and defer all of that tax liability. And there are a number of components that go into that tax liability, various forms of tax that can be deferred. But the ability to preserve your purchasing power, to keep all those funds working for you, and have flexibility as it relates to the replacement property that you're acquiring. One of the terms that you'll hear used for a 1031 exchange is this concept of like kind. The property that is sold, what you'll hear called the relinquished property, and the property or properties, very much can be plural, that you acquire, i.e. your replacement property, they must be like kind with one another. And when people are learning about exchanges at first, it's easy to hear that phrase like kind and think, oh, well, if I'm selling a single family property, if I'm selling a multifamily property, I must need to purchase the same property type. But in actuality, the IRS's definition of like kind is quite broad, and it's not focused on the location of the property or the type of the property, but instead the intent as to why that property is owned. And importantly, all real estate, all property held for business or investment purposes is like kind with one another. So you can sell that single family rental and exchange into self-storage or hospitality or multifamily or medical office. You name the property type. If it's held for business or investment purposes, it is 1031 exchange eligible. Additionally, you can take those sales proceeds from a relinquished property that you sold in Southern California, on the Central Coast, in the Bay Area, wherever it may be, and exchange into any market in the United States. We talk to a lot of property owners who don't like the direction that California is headed from a regulatory environment standpoint, from a tax structure standpoint. more recently, from a demographic trend standpoint, as we're starting to see the population actually decline, and many economists are saying California's population may very well be flat through 2030, which is frankly unprecedented because California has had consistent year-over-year population growth since about the 1930s until more recently. And perhaps taking those dollars then that would result from the sale of a property and reinvesting in markets where you see more opportunity, more runway, perhaps a more balanced regulatory environment. All of that is very much allowable with the 1031 exchange. When we're talking about the sale of a property in California, the maximum applicable tax rate that you could be looking at upon that sale is as high as 42.1%. Imagine that someone purchased a property for, let's say $500,000 or $1 million. It's appreciated significantly. Maybe it's worth $2 to $3 million now. And upon that sale, they're losing anywhere from a third to say 42% of those proceeds in tax that's then being paid. It's tragic, but it doesn't have to be that way. You can take all of your sales proceeds and defer that tax liability. Now, one item that we are commonly asked is, well, if I'm going to do an exchange, aren't I going to have to pay that tax liability eventually? And that's one of the beautiful things about California is California is a community property state, which means that you can keep deferring that tax liability until eventually you or your spouse pass away, at which time you get what's called a step up in basis. And all of that deferred tax liability is then eliminated for a surviving spouse and then eliminated again when that surviving spouse passes away for those beneficiaries. And that presents an exchange strategy that you'll hear people refer to as swap until you drop. We'll just keep pushing that tax liability out into the future until someone passes, and then that deferred tax liability is gone. Quick visual representation here of this concept of like kind. As I mentioned, all property types are eligible to be like kind with one another, provided they are held for business or investment purposes. Another quick visualization of, from an income standpoint, the power of performing an exchange and keeping all your dollars working for you. So on one hand, the left column, we have a scenario where someone has a $2 million sale. Estimated gain is 1.5 million, and the tax liability attributed to that gain is just under 725,000. So if they elected to pay tax on that sale, they're walking away with somewhere in that $1.275 million range, reinvested into any investment, generating 5% cash flow. We're talking about just under 64,000 of income on an ongoing basis. You contrast that to an exchange scenario, $2 million sale, $1.5 million gain, but no tax paid. All of those funds reinvested, that same 5% cash flow is generating $100,000 of cash flow. Or that same 5% return, rather, is generating $100,000 of cash flow. Now let's pivot into talking about how to calculate your tax liability. Our process in working with investment property owners begins with education. Owners need to understand the strategies they have available to them, the options they have available to them, and the inputs that are going to be critical for making an informed decision. And the tax liability that would be due upon the sale of your property is a critical input to understand. Unfortunately, it's not quite as simple as saying, I bought the property for X amount, I'm selling it for X amount. The delta between, the difference between is my gain, and that's going to be subject to a specific tax rate. There are a number of components of your sales proceeds that can be subject to tax and at different rates. We have federal capital gain tax. We have state income tax, also referred to as state capital gain tax, depending on what dollars we're attributing that tax rate to, but they're the same tax rates. It can be as high as 13.3% in California. We have federal depreciation recapture tax at 25%. We have state income tax that can also be applied to the accumulated depreciation, again, up to 13.3%. And then lastly, the almost always overlooked net investment income tax, which is an additional 3.8% federal tax that can be applied to both your gain and your accumulated depreciation. California is not the only high income tax state in the country. There are many others, one being the neighbor to the north in Oregon, and if we want to call it the neighbor to the west, Hawaii as well. But there are multiple states that have high state income taxes. And if you live in one of these high income tax states or own property in it, the benefit of performing an exchange is just that much greater. What we have here is what is perhaps at first glance kind of an overwhelming table of the components of calculating that tax liability. I think it's important for people to understand the concept and the framework, though, so that when you are, say, utilizing our tax liability calculator, you'll know what's happening behind the scenes. First, whenever we're calculating a tax liability, we need to know the sales price of the property. That's critical because that's a reference point that is going to end up being an important part of establishing that gain. So let's say in this scenario, we have a sales price of $200,000. Step one is to calculate your net sales proceeds. By net sales proceeds, what we're referring to is your sales price less any of your selling or closing costs attributed to that sale. What's included in selling and closing costs? Title, escrow, brokerage fees if you are utilizing brokers for the sale of the property. What we're not going to see included in the selling costs, though, is anything that was spent to prepare that property to sell. So they need to be actual transaction costs. If an attorney reviewed your purchase and sale agreement, or if you worked with an attorney as opposed to using brokers, very much a selling cost. Any sort of loan payoff cost, that's a gray area. That depends on your CPA stance. But typically we're looking at, call it 5 to 7% of the sales price of the property attributed to selling costs. Those are deductible expenses. So those get taken right off the top. And that gets us to net sales proceeds in this scenario of $1.86 million. Then we're going to start at the bottom and build our way up. So we've got our sales price less our closing costs. Now we're going to look at the original purchase price of the property. Here in this example, we have a property that was originally acquired for $450,000. And what we're going to do is we're going to add to that any capitalized improvements. Now, if you're wondering just what was capitalized, what was not capitalized, where you can find that information is by going and looking at your depreciation schedule. Because if it was capitalized, it should be included on your depreciation schedule that accompanies your year-end tax return. But those capitalized improvements plus the original purchase price is going to equate to our original tax basis for the property. In this example, we have a scenario where $450,000 was the original purchase price and $100,000 of capitalized improvements gets us to an original basis of $550,000. First calculation to be performed that's going to give us a bucket of dollars that are going to have a tax rate applied to it. Your net sales proceeds, $1.86 million, less your original tax basis is your taxable gain. This in blue that you see here, $1.31 million, is the bucket of sales proceeds that will be subject to federal capital gain tax, state income tax, and most likely net investment income tax of 3.8%. Next, we're going to look at this accumulated depreciation bucket. And what that is your original tax basis less the sum of the annual depreciation that you've taken over the years or quite possibly decades that you've owned the property. So in this scenario of the $550,000 of original basis, we have $520,000 of accumulated depreciation. Jump down to the purple or pink rows that you see at the bottom of this table. Those dollars, the $520,000 of dollars, are going to be subject to 25% depreciation recapture tax at the federal level, state income tax, and net investment income tax as well. Ultimately, what this scenario leads to is a tax liability just shy of $705,000 on $2 million of property being sold. Now, I do not expect everyone to go recreate the formulas within that particular table there. And you don't have to, because we have a tax liability calculator available for anyone to use on our website. You can scan the QR code that you see here, or you can visit our AOA hub that you see in the bottom corner of the slide, where we've taken all of our site's content and really pared it down to what we feel like is most applicable for AOA members. But visiting that tax liability calculator will allow you to type in your own inputs. First step, again, putting in the sales price and your estimated selling costs. Now, if you're not using brokers, your selling costs will be lower. If you have excise tax that you need to take into account, depending on the location of your property, that would go into your selling costs as well to get us to that net sales proceeds. Then we need to look back to when you originally purchased the property. We need to put your original purchase price in there. We need to add the capitalized improvements, not any and all improvements, just those that ultimately made it onto your depreciation schedule and were capitalized. So add those to get to your original tax basis. Then we now know our gain, our appreciation, if you will, that the property realized. And that's going to have a certain amount of tax applied to it. Then we're going to look at, again, on our depreciation schedule, the amount of accumulated depreciation taken over the period of ownership. And we're going to plug that figure in. That will give us the amount at which the 25 plus 13.3 plus 3.8% is going to be taxed at. And it's going to calculate based off of your inputs, your state of location. It'll automatically update based off of where the property or you as a resident are located. That's going to then translate to the calculation that you see at the bottom of the slide. So let's take all that tax talk, let's move it into a scenario where a husband and wife whom we worked with, Walter and Maria, they were engaging us to go through this process of discussing their objectives, discussing what they own, establishing a strategy, and then evaluating replacement property options and ultimately what they elected to proceed with. So here we have a couple that was looking to address a number of objectives that we commonly see with property owners. They wanted to have more time to travel, to spend time with their grandchildren. They did not want to be burdened by their investment in real estate. If they like real estate as an asset class, they want to continue to be invested in real estate. But the property that they own, while it's performed very well, especially from an appreciation standpoint for them, no longer fits with their objectives. The subject property in particular was a 10-unit multifamily property in San Diego, purchased originally in 1987 for $850,000. And then here we are in 2024. That property is now worth $3.5 million. And it's generating income for them, at times fairly good income. However, they felt the regulatory burden. They know that if there's a major repair like a roof, that can end up diluting cash flow significantly in a given year. And they've dealt with some tenant issues. So they're saying, well, not only on top of all of those objectives, we also want to have our time back and we want to diversify. But if Walter and Maria were to sell, the tax consequences would be significant. Using that same framework and approach that we walked through before, that was going to translate to a tax liability of just under $1.15 million. Walter and Maria felt great about the $850,000 purchase price and the $3.5 million value, but when they thought about swallowing the tax liability and having to ultimately reduce their proceeds by over a third, that was in large part a non-starter for them. Herein lies the 1031 exchange. Based off of the objectives in which we heard from them, they wanted that predictability of cash flow. To the extent possible, they wanted higher cash flow. They wanted diversification. They also were going to likely end up having more income from their replacement properties than what they're currently experiencing. So they wanted to shelter as much of that actual rental income from being subject to tax as possible. So in turn, what we did is we designed them a tailored portfolio of DST replacement properties to meet those objectives. That included 2 Class A multifamily properties in growth markets, Dallas, Texas, and Charlotte, North Carolina. Here is where we really see there being income growth opportunity and appreciation potential. That whole concept of preserving one's purchasing power is critical for someone like Walter and Maria, given they likely have 20 plus years ahead of them. So we need to see some appreciation in this portfolio. 30% allocated to a corporate guaranteed net lease retail portfolio, 20% allocated to a single tenant industrial property. This is the piece of the portfolio where we're really getting that stable, predictable income stream that shouldn't be going anywhere. Maybe not as much appreciation potential, but a very reliable source of cash flow, and often higher cash flow as well, while providing diversification for them. That exchange was a perfect example of how the tax liability can be identified. And then in turn, we know an exchange is largely necessary for that client, and a replacement property portfolio can be designed and tailored for them to meet their specific objectives. If you're interested in having a conversation with one of the exchange advisors on our team, reach out. We'd be happy to chat with you, whether that's discussing the specifics of your situation, or maybe you have some questions about the tax liability or want to be walked through the tax liability calculator, or 1031 exchange rules and requirements, or the replacement property options we work with. Regardless of the subject, if you're interested in discussing with one of our exchange advisors, you can do so by either visiting our AOA hub, again, that you see at the bottom of the slide, and scheduling a consultation, or calling the number that you see at the bottom of the slide, in which case one of our team members will field your call and then has access to all of our advisors' calendars and will schedule accordingly. Additionally, if you'd like to dive deeper into the Delaware Statutory Trust replacement property type further on your own, one way to do so is by downloading our guide to investing in DSTs, which is available on our website. It's about a 28-page guide that gives an overview of, call it, the history and the structure and the mechanics of DSTs, as well as talking about some of the strategies available using this form of replacement property. And then lastly, webinars are a near weekly occurrence here at RETS. Here are 2 of our upcoming webinars in mid-September, and then also the early part of October, 1st of October specifically, in which we'll be discussing exchange strategies, and then also specifically focusing on estate planning and how 1031 exchanges and DSTs can be utilized to make for a seamless estate planning transfer. Well, Jeff, that's all I have on my end. We have some FAQs here that we can hop to, or if there's questions that have come in from anyone who joined us today, we can also go that way too.
Great. Yeah. So now is the time to get your questions in. If you're watching on AOAUSA.com, there's a blue help button on the bottom right side of the screen, and you can type your question in there. They'll get that over to me, and YouTube, Facebook, pretty easy to put that in the chat. And yeah, we do have one question already. And I did want to comment, I like that t-shirt. That was cool on the slide before last. It had the DST stuff. That was pretty cool there. Anyway, and guys, look at that. There's all these, use that calculator for your own personal property, and go over that retransition.com/AOA and get that. That's pretty cool. Yeah, there's the t-shirt. I love that. Isn't that cool?
We'll send you one, Jeff. Give me a good workout shirt for you.
Yeah, there we go. Definitely hit it hard this morning and feeling great. It's so good to get a good sweat up and just take care of the $1 billion asset that each of us have.
There you go. Exactly.
And yeah. All right. I did forget to mention that we do have 2 live streams next week. There is another one at 1:00. And for those of you that are in the LA area, there's the pending rental assistance application and how that is impacting housing providers. So that's another one. So just tons of resources, but yeah, we can get into the questions here. On YouTube, Miss Queena is asking, is it possible to find a replacement property in another state?
Absolutely. So when you look at the 1031 exchanges and section 1031 of the tax code, that's coming right out of the federal tax code. which means you can sell property anywhere in the United States and acquire replacement property anywhere in the United States and defer not only all of the federal tax, but whatever state taxes would be applicable as well. Now, one nuance to know about as a California resident, or if a property is physically located in California, when you exchange out of California, California does require an annual disclosure to be filed with the Franchise Tax Board, stating that the replacement property you purchased out of state, let's say you exchanged into property right across the border in Nevada, the replacement property that you purchased there has yet to be sold and the tax liability recognized. And what's happening is California is tracking that property with the intent of, should you sell it and should you recognize a tax liability, they want to claw back the tax that was attributed to the appreciation and depreciation taken while located in California. Now, if you keep deferring your tax liability until you or your spouse pass away, then really all we're talking about is just an annual disclosure. And then once someone passes, that step up in basis is realized, that tax liability is eliminated. You no longer need to file that disclosure. But there are no limitations on where you can purchase property within the U.S., but it does need to be located in the domestic U.S.
Great. Great. Thank you for that. And I was curious, you had the case study with the couple, and I was curious, what was their cash flow before they did the 1031 exchange? Do you know what percentage they were at?
Yep. I think we have that figure from a dollar standpoint, not a percentage standpoint in the example. And I think it was just over 100,000. So 105,000 is what I'm seeing here on $3.5 million of property. When we calculate that cash flow as a percentage, we're going to back out the closing costs. So we're looking at we'll call it the net sales proceeds. There was no debt on this property. So net sales proceeds and equity in the property at the same figure. But 105,000 divided by 3.255, we're somewhere right around just under 3% cash flow, which is not all that uncommon for what we see with a multifamily property that's really been managed with the intent of, we'll call it preserving occupancy, as opposed to pushing rents up to where they could be in the market, knowing that that can lead to some turnover and some improvements being required. When we talk about single family rentals, and then even more so for condo rentals, it's not uncommon for that to be closer to 2.5%. And it's not because, for the record, these properties are poorly managed. It's just that the properties have appreciated dramatically. And remember that calculation is income as the numerator and then equity in the property as the denominator. So the higher that property value goes up, unless the income's growing with it at the same rate, that percentage is going down. And we look at that as kind of the return on equity, the opportunity cost. And when you compare that to a DST portfolio like Walter and Maria ultimately exchanged into, they were probably looking at around 5.25, 5.3% first year cash flow. So at 3.25 million exchange, maybe they're in the 165,000 range. I don't know if we have that explicitly stated here. That's a pretty substantial increase in cash flow, especially given, they're entirely passive now, they're diversified, et cetera.
Right.
Yeah.
Right. That's great. That is awesome. And one thing that people ask a lot is, what's the sales cycle? Are they, obviously real estate is illiquid. And so what's the sales cycle, the normal sales cycle for a DST 1031 exchange property?
Yeah, that's a very important question. So typically 5 to 7 years. That's the average hold period we see for DST replacement property. That will have some dependency on where the market's at, because the sponsors, the managers of these properties, they're going to manage them until a sale event would lead to meaningful return for the investors. So they're not going to sell them in a down market. They're going to wait until the market supports the sale. They don't want to have anything less than a positive outcome on their track record, and the investors don't want that either.
Yeah.
But 5 to 7 years tends to be the typical hold period. They are, inherently illiquid investments, so you need to be comfortable holding that investment for those 5 to 7 years. And there are some DSTs, some subcategories of DSTs and different structures of DSTs that facilitate, we'll call it more liquidity faster, which, if that's something that's necessary for an exchanger, let's absolutely take a look at that. But 5 to 7 years tends to be the period.
Great, Austin. And then we have Armando asking, in the swap till you drop tax avoiding scheme, how does step up in basis apply to DSTs if the person drops mid-contract? So let's say they were to exit, and whether it's mid-contract or even if it's the full term, what's going to happen? What's their tax consequence on that? Either way.
Yep. So, same mechanics apply, right? We're going to need the fair market value any assets, and this is something in which you would work with your tax preparer on, whoever is preparing the return for the estate itself. Everything from your stocks, your bonds, your home, any assets that you own, there should be a value put forward for it. And that's something that we can assist with. And there's a couple different approaches that we'll take depending on the period of time between the investment and the step up, when the investment was made, the size of the investment, the property type, how comparable that specific property is to other DSTs. We'll call it the scrutiny that estate may get placed on it. All of those are considerations that will go into just how we approach the step up process. But then that value would get put forward, and the estate would record, hey, this DST that had been invested in and 500,000 invested now steps up to 565,000 or whatever amount it would be. And then when that likely would end up eliminating all of the gain that had been exchanged into that property. And then what would occur is, say there's 3 more years of ownership or 6 months more of ownership and the DST property sold, the surviving spouse would then be able to take those sales proceeds, with the only tax being due is any tax attributed to the appreciation and depreciation taken from the dated debt and that new high watermark for a value.
That's a good question. All right, Dean, can you review how a DST works when there is a loan still on the property?
Absolutely. I mean, anyone who owns investment real estate that has debt on it right now, has a mortgage, a loan on the property, this is going to be very relevant for them, because if you have a pulse for 1031 exchange rules, you'll know that there's 2 requirements from a value standpoint in order to have full tax deferral. 1, you have to purchase replacement property that is equal or greater value to that which you sold, less your closing costs. 2, you have to reinvest all the equity resulting from the sale. So if you have a $2 million property sale, $100,000 of closing costs, that means you need to purchase $1.9 million of property value. And let's say you have a $900,000 loan on that property, you have $1 million of equity to go buy that $1.9 million of property. Now, at this point, for full tax deferral, you have 2 options. Either you bring $900,000 to the table and you buy replacement property for $1.9 million, all cash. Most people do not want to do that, and completely understandable. Or you purchase replacement property that has debt, that has a loan on the property, has leverage on it. And I would say somewhere around 2/3 of DSTs have leverage on them. Typically, it's in the, we'll call it 30 to 50, 55% loan to value range. But that debt will be secured by the property. Every person who exchanges into that property, every investor will pick up a pro rata share of the debt. It's non-recourse to the investors, which is great. There's no guarantees, personal guarantees. It's just fully collateralized by the property itself. So going back to that scenario where someone needs to purchase $1.9 million of property and they have $1 million of equity to do so, they have about a 45% loan to value, which means your DST replacement property portfolio would need to have at least a 45% loan to value if your goal is to have full tax deferral and not contribute any cash to the exchange.
Great. All right, Millie, when beneficiaries inherit multifamily property, if they want to sell, are they subject to the same capital gains taxes? And can they do a split 1031 exchange? So we kind of answered the first part just now.
I mean, theoretically, there's a scenario where they would not get a step up in basis if there were various trust structures used, like the property was parked in an irrevocable trust before the parent, say, passed away. But for the most part, in most situations, you should get that step up in basis. Say 2 adult children then inherit the property. The question as to whether or not they can do a split exchange, they can go separate ways, will depend on how that inherited property is held, how it's titled. Is it in an LLC together, or is it in a tenant in common? And the tenant in common is going to give the most flexibility for people to go separate directions. If that inheritance of the property happened recently, we don't even need to talk about an exchange, because you would have gotten the step up in basis, which means you're really not going to have any tax consequences associated with the sale. Now, if the step up in the inheritance happened 10, 15 years ago, which is often the case, or even 5 years ago, and there may be meaningful gain since then yes, we absolutely might want to be looking at a 1031 exchange and strategizing how to best do so if the goal is to go separate directions, or one may want to pay tax and one may want to exchange. Those are the scenarios we work through all the time. And I would very much encourage you to reach out. We'll have a 15, 20-minute phone call, answer your questions, learn about your situation, give you some guidance.
Great. Look at that. You'd be talking to a CPA. So, which is really nice. All right, John here. Understand that step up in basis occurs upon death for federal basis. What about state of California?
Absolutely. Yep. Still receive a full step up in basis.
All right, John, thank you for the question. Dad's Liquor. When a property is in an LLC, can you retain the step up in basis in a 1031?
Mm-hmm.
All right.
Mm-hmm. Yes.
There you go. And that's all the questions that we have for now.
Okay.
Thank you guys for asking great questions. And if you might get a question in here late as we're ending, but definitely, oh yeah, looks like there's one more here. You can give Austin a call. Can you stop sharing your screen? And then I think we'll get probably get a bigger phone number and all the contact information will probably come out better.
Okay.
Okay, now they're coming back in. All right. CT on YouTube. Could you briefly talk about the step up? Oh, the steep commissions being paid to intermediaries going into DSTs, sometimes as high as 15% of investment.
Oh, yeah. I mean, absolutely happy to talk about the structuring costs. I don't know that I've ever seen a DST that has that much compensation for the representative who's working with the exchanger. That would be appalling, frankly, if they were that high. The compensation that firms like ours will earn is going to be consistent with what you'll see for buyer's representation for any commercial real estate. And when we talk about a DST that's leveraged at, say, 50% approximately, it's typically 2.5% of replacement property value acquired, which that's pretty commonplace. Occasionally we'll see 3%. It's right in that range, though. What happens mechanically with the DST is a sponsor will purchase a property first using their own capital, their own balance sheet. Then upon the purchase of that property, after having worked through their due diligence process, we step in, and typically when they're under contract and non-refundable is when we begin our due diligence process of the property. This is assuming the sponsor themselves has already worked through a full sponsor level due diligence with us, which is typically about 6 months. And then we begin looking at each and every property that they are acquiring. When they acquire the property, structure the trust around it, provided it meets our due diligence standards, then we can make it available to exchangers whom we are working with. And there will be a delta between the sponsor's acquisition price of the property and what's referred to as the offering price, the price at which it's made available to the investors. Any of the return figures, projected cash flow, historic appreciation, that's always going to be based off of the full investment amount by the exchanger. So if we're talking about a DST that has, let's say, projected 5% first year cash flow, and someone's contemplating exchanging 500,000 into that DST, we're talking about $25,000 of projected cash flow. And if we say with that particular sponsor, historically, we've been seeing a 10 or 12% annual rate of return, income and appreciation, then we're talking about 10 to 12% on their full 500,000 invested. But that spread between the sponsor's acquisition price and the offering price, that's typically in the, call it 8.5 to 9.5% range. So not getting anywhere close to 15% on leveraged DST properties. And then very lean from the sales standpoint as well. And one of the nice things about DSTs is the fact that legally the sponsor is not allowed to participate in any appreciation that the property realizes beyond a defined disposition fee, which is typically 2.5 or 3%. So should that property appreciate in value, which historically has very much been the case, then at that point, all of that appreciation goes to the investors pro rata based off of each individual investor's percentage ownership.
Great. Had a little camera trouble, so fortunately had a backup here. I think that kind of answers Armando's question about what's the ballpark cost for a 1031. Yep. I think that kind of answers it. Any additional information, any additional that you'd like to for him, where he just asked, what's the all-in cost?
I mean, that very much should answer the question.
Yeah, pretty much should. So yeah, great. Okay, one more. Here we go. They keep coming in. Mr. Cal State, how about 1031 exchanging like 8 properties, their individual condos for a multi-unit apartment? Can you work on timing of different sales, which will probably be over the time allowed for a 1031? So how could you accommodate for that? Yeah.
So we commonly see a single property sale end up being exchanged into multiple replacement properties. And the inverse is very much allowable, syncing up multiple sales and aggregating them and exchanging it into a single larger property. But mechanically, that's much more difficult to do because you're going to need to put extensions likely into your sales at your discretion, at the seller's discretion, which most buyers don't love, to say, if we place 1 or 2 of these condos under contract early, we are going to need to play out that contract period long enough so that we can get the other properties sold, so that all these condos are selling within typically, say 1 month period of one another, and we can put them all in the same exchange. It's theoretically doable. I mean, it's allowable, but it would be very difficult to do.
Great. Hey, Austin, thank you so much. You've done a 721 UpREIT live stream.
Oh, yeah.
If I remember right. And we have one CT's asking about that. And so if you search, they can go to your website and maybe find one.
Right.
And also on our YouTube channel, the AOA USA, you could type in real estate transition solutions and 721, and then it would pull that up. So if you're watching on just the our AOAUSA.com website, we do have a YouTube channel. It's AOA USA. A lot of you are just watching from there already. So you're like, doesn't everybody know? But yeah, some people, they're newer members and they're not aware of it. From AOAUSA.com, there's a little YouTube icon up at the top. If you click on it, it'll take you directly to there. And then on our channel, you could search that and find something from Austin about it. And that's just the 721's great to make things a little more liquid. And anyway, hey, we appreciate you a whole lot.
Always a pleasure, Jeff.
Yeah, it really is. It really is. You're awesome. And you always just bring you have such a peaceful aura about you. You bring great expertise. So I always enjoy it. And yeah, so we'll see all of you. We got one coming up here at 12 o'clock. And next week we have another doubleheader, and then we have all these in-persons. There's a lot that's changing, and there's a lot of information that we want to bring to you, because our goal is to have the most successful group of real estate investors in the state. And you get there by sharpening the axe, going to the trade show. Man, the trade show was awesome. We had over 2,000 people there. You guys donated so many unwrapped toys for the Christmas program that, so just incredible. There were like 12 boxes of like bins of toys. So just incredible. And so thankful for the generosity there. And you guys, if you haven't opened up your wallets on the Prop 33 thing, open it up, get the yard signs out there, and let's get some more billboards up. You got to love that Pinocchio. It definitely grabs the eye. And if they scan that QR code, they're going to see some real reasons that would actually relate to who they are. And anyway, thanks again, everyone. And give Austin a call, and go do that calculator. See what it turns out for you. And again, thanks everyone. We'll see you next time.
Thank you, Jeff. Have a good afternoon.
All right. Thank you. Bye-bye.